we found the bottom at 60,000. The high was last October, about 125,000. I think we bounced off 60,000. We're in the mid-70s right now. There seems to be a good base for support. I expect we'll rally from here into a crypto spring.
Saylor begins by addressing the biggest frustration among Bitcoin investors right now. Despite ETF adoption and growing institutional interest, Bitcoin has struggled to decisively break above major resistance levels. According to him, the primary reason is simple. Capital has been flowing aggressively into AI-related equities instead. Right now, global markets are obsessed with the AI boom. Companies tied to artificial intelligence, semiconductors, and high-performance computing are attracting enormous amounts of investment capital. That enthusiasm has drawn liquidity away from crypto markets temporarily. Interestingly, Saylor points out that even Bitcoin miners themselves have been rotating capital into AI infrastructure businesses. Many miners are now using their existing operations and energy resources to build high-performance computing facilities for AI companies. To finance that transition, some miners have been selling Bitcoin or borrowing against their holdings, creating additional selling pressure in the market. But Saylor views this as temporary noise, not a structural weakness. In his view, Bitcoin's true catalysts are macroeconomic and geopolitical. He believes Bitcoin performs best when monetary policy loosens, when central banks begin easing liquidity conditions, and when geopolitical tensions start calming down. At the moment, high interest rates, trade wars, and global conflict are creating uncertainty across all risk assets. And Bitcoin, because of its extreme liquidity and leverage, reacts more violently than most markets. And this is where Saylor introduces one of his most important ideas.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
My guests that I've been speaking to have been wondering why Bitcoin hasn't been gaining the same momentum as, say, stocks, for instance, which have continued to hit these record highs. And I'm just wondering what the fundamental catalyst would be to break through that heavy resistance we're finding just north of 80K right now.
Yeah, well, stocks are beneficiaries of the AI trade. There's a lot of capital flowing into the equity markets because of enthusiasm around AI and tech. That capital has been drawn out of the crypto market to a certain extent because many Bitcoin miners have been rotating into AI, high-performance compute, and they've been selling Bitcoin or they've been refinancing their Bitcoin to do that. So that's the headwind. Really, the drivers for Bitcoin right now will be macro. As we start to see a loosening monetary policy, that'll be very good for Bitcoin. A cessation of or a lessening of tensions with the trade wars and with the hot wars in the Gulf. Both of those are good. Bitcoin's driven by geopolitics. For example, crypto billionaires out of China, out of the Middle East, out of Asia, out of Africa. And so when they feel pressure, sometimes they're selling. It has nothing to do with the U.S. equity capital markets.
I'm so glad you mentioned that because I'm wondering how much of this move that we've seen is related to outside of the U.S. For example, the potential for a carry trade unwind with Japanese intervention coming from the officials over there, or that capital flight which has been catching a lot of attention out of the Middle East because of the Iran war.
Well, Bitcoin's digital capital, and if you think about risk assets and you think tech sometimes is risk squared, Bitcoin sometimes feels like risk cubed in a way. Yeah. And the reason why is because it has the most free market in both yield and also leverage. So if when the crypto market is feeling a little bit bearish, they'll be 10x bearish. They'll lay on a 10x negative trade, and for every one Bitcoin, they might sell 10. But when they're feeling bullish, they'll be 10x bullish. And so the market comes with a huge amount of volatility, but the volatility is because there's a huge amount of liquidity. The liquidity is because there's a huge amount of credit in this entire crypto economy. You have to factor that into your thinking when you're investing in it.
I do want to pick up on your thought about macro, because now obviously we're looking at what, a 10-year yield at 460. I'm just wondering whether the higher sort of global yield environment right now is a headwind or a tailwind, with the Fed now looking to maybe remove that easing bias, and the market's now pricing out cuts and easing?
Yeah, I think the tightening monetary policy is a headwind. I think the hot wars are a headwind. I think trade tensions are a headwind. The tailwinds will come from a variety of other areas. The regulatory adoption, like the passage of the Clarity Act, the issuance of the innovation exemption for tokenizing digital assets and tokenizing securities coming out of the SEC, the formation of bank credit, like Schwab extending credit on Bitcoin, other banks extending credit on Bitcoin. That's a big tailwind. And then the explosive growth in the digital credit market, markets like STRC, which are taking up 2 to 3x the natural supply of Bitcoin this year, and just all by themselves.
I do want to talk about the broader crypto industry type of tailwinds and developments we've seen in the last 6 months, and also STRC. But one recent change as far as your strategy is concerned that's getting a lot of attention right now, I heard you talking about this morning as well, saying you would never sell BTC, to now the potential that you could sell it. Would you sell or not?
Yeah, I think never selling Bitcoin is a good admonition for a retail investor and a hodler. Someone ought to just hold it for life, and it ought to be the thing you hold for a decade. We're a public company, so our objective is to maximize Bitcoin per share over the next, say, 7 years, like a long-term Bitcoin per share. The way we do that is by dynamically allocating capital. We have a dynamic capital allocation model, and on any given day, we can utilize cash, we can sell BTC, we can sell equity, MSTR, we can sell credit like STRC. And normally our decision of which of those things we're selling or what we're swapping is a function of the Bitcoin price, the equity price, the credit price, and capital markets forward interest curves.
And something interesting also that you mentioned earlier today was the fact that you're buying Bitcoin at a faster rate than the miners can produce it. I heard you actually saying that you're probably going to buy all the Bitcoin that gets produced between now and 2140. I don't know how your succession planning looks over at Strategy, but how does that work?
Well, the miners produce about 450 Bitcoin a day. That works out to, say, $10 to $11 billion a year.
Right.
We bought $11 billion of Bitcoin so far this year, and we're not even halfway through the year. So we're already buying at 2x the rate at which they're able to produce it. The digital credit business, STRC, has been an explosive success. It's gone from 0 to $10.5 billion outstanding in 10 months. But we sold about $2 billion of that credit in May, which means we're at a $24 billion run rate. So just that one instrument alone is going to account for 2 to 3x the Bitcoin supply that's produced by the miners.
But how does that work from supply-demand type of dynamics? I mean, if you're absorbing everything that's being produced right now, if you're looking to buy Bitcoin, then you're looking to buy it within what is in circulation, away from what is being produced as well.
Yeah, once we bought all the Bitcoin available by a natural seller, the price has got to actually move up to find a willing seller. So the way to think of it is there's a consistent bid that covers all of the natural or organic sellers. And once that happens, every single time $10 billion of capital flows into this marketplace, that's 1 year's supply or one turn on the axle. So, you know, $10 billion or more may flow into the ETFs like IBIT. That's one source of demand. Banks are creating credit, so when a bank issues or creates $10 billion of credit against Bitcoin, that's another year's supply. Other companies like Strive are selling credit instruments like SATA, that's creating demand, and of course our company is creating massive amounts of demand. All of those things are just turning the axle, powering up the network, driving up the price, and they have an effect of damping the volatility. One of the reasons, if you go back about 4 years, we traded down 75% peak to trough. And this time, the drawdown wasn't nearly as bad, and the reason why is because there's another source of demand that's consistent every day.
Right. I mean, there's a view that Bitcoin is becoming increasingly dependent on you actually buying Bitcoin. I mean, as broader investment demand, particularly from retail trading slows, and also because of the miners selling Bitcoin, as you've mentioned, to kind of fund the AI infrastructure build out. Is that true? And is there a risk of that being dependent on you so much?
I wouldn't use the word dependent. I would say we have become a material player in the space. 5 years ago, we were not a material player. Now we are generating $10, $20 billion of demand a year or more, so that's significant. But also the ETFs like BlackRock are very, very material and significant. The other Bitcoin companies are also significant. And really, the elephant in the room, the really big players with the big capital are the big banks. You know, JP Morgan, Morgan Stanley, Schwab, Merrill Lynch, BNY Mellon, Wells Fargo. They're all, to one extent or another, coming into this space, creating credit, beginning to custody and trade this asset. And any one of them can be as big or bigger than we are. And all of it's bullish because no matter how many people are in the space, there's only going to be about $10 billion of organic supply at this price level. So logically, the price has got to move up as adoption increases and interest expands.
Saylor describes Bitcoin as something even more volatile than technology stocks. If tech stocks are risk squared, Bitcoin is risk cubed. Why? Because Bitcoin exists inside the most liquid, leveraged, and globally connected financial ecosystem in the world. Crypto markets operate 24/7. They allow massive leverage. Traders can go 10x long or 10x short almost instantly. And because of that, Bitcoin experiences exaggerated reactions in both bullish and bearish environments. When sentiment turns negative, traders aggressively short the market. When sentiment turns positive, leverage floods back in just as aggressively. This creates enormous volatility. But according to Saylor, that volatility is actually evidence of Bitcoin's strength. The reason Bitcoin remains so liquid is because there is an immense amount of global credit, capital, and financial energy flowing through the ecosystem. And unlike traditional markets, Bitcoin isn't only driven by U.S. investors. Saylor emphasizes that Bitcoin has become global digital capital. Investors from Asia, the Middle East, Africa, and China all use Bitcoin differently depending on local economic conditions, political tensions, or capital controls. So sometimes Bitcoin selling pressure has absolutely nothing to do with Wall Street or U.S. stock markets. It may simply reflect capital movement happening elsewhere in the world. That global nature makes Bitcoin far more complex, but also far more powerful.
And just to be clear, to confirm before we move on and talk about STRC, last time you and I spoke, you held about 640,000 Bitcoin, representing about 3%. How much is that now?
We're about 840,000 Bitcoin, representing about 4% of all the Bitcoin that will ever exist.
Okay. So let's talk about Stretch. You buy the Bitcoin to issue in different credit instruments for those who don't want to stomach the risk, obviously. So can you explain exactly how this particular product works?
Sure. This is asset-backed credit. So imagine I had a tower, $100 billion of equity capital, and I bought the S&P index. And I thought the S&P is going to go up 12% a year. Well, I could sell $20 billion worth of credit, and I could give you 8%. And I could over-collateralize that credit 5-to-1. And so my pitch to the investor would be, I'll give you over-collateralized, structured equity-backed credit that'll pay you 8% in some return of capital dividend. And if you don't want to get on the S&P roller coaster and take the 15% drawdowns to get to 12%, I'll give you a much lower volatility stable instrument. You'll get 2/3 of that. And there's a lot of people that like that. That's a structured product. Traditionally, banks have created and packaged that product and sold it to their customers. But you might ask the question, why did a public company like Berkshire Hathaway, why didn't they create that instrument? Because it's kind of a no-brainer. I would buy it. And the reason is because the Investment Company Act of 1940 precluded a publicly traded company from capitalizing on a securities portfolio. So, hence comes Bitcoin. Bitcoin is digital capital, but it's a commodity. So imagine I have $100 billion worth of capital equity now. I buy Bitcoin with it. I could sell $20 billion worth of credit, 5x over collateralize it, but now instead of paying you a fraction of the S&P return, I pay you a fraction of the Bitcoin return I expected. So that's about what our company has done. we expect Bitcoin to appreciate 20 to 30% a year. We're offering 11.5% as a dividend yield on STRC. It's structured and engineered to trade around par, which is $100.
Right.
And when it trades above $100, say $100 and a penny, we have a shelf registration, so we sell more of it into the market to keep it at 100. When it trades below $99, actually when it trades below $100, we won't sell it ever. If at $99.99, we wouldn't sell any of it. And when it trades weaker than that, say it trades below $99 for more than a month, we would raise the dividend, or we would raise capital to collateralize it better so that we can strengthen the instrument to get it trading back at par. And so because we have these instruments of being able to adjust the dividend rate and raise capital and then sell the instrument when it's too strong, we can strip the volatility off it. It's traded with a vol somewhere around 3. The Bitcoin volatility is 40. And so we've stripped the 40 down to 3. We've got it to trade right around 100. It's the lowest volatility of the major credit instruments. And the dividend we pay is a return of capital dividend, because if you're disciplined in the way that you monetize your capital gains, you would monetize an unrealized capital gain and you'd be able to offer a dividend, which is a tax-deferred dividend. And so the magic of the instrument is, we know that Bitcoin's going to appreciate more than 11% over time. We're transforming a capital gain into a credit dividend while we strip away the economic risk, the volatility, and we extract the cash flow for the credit investor.
So you have the ways, the means, the tools, whatever have you, to defend that $100 peg in order to meet those obligations, which is that 11.5% dividend. I mean, that's pretty attractive, right?
Yeah, a great acid test is you could have bought Stretch on October 6th of last year, or you could have bought Bitcoin. If you bought the Bitcoin, you'd be down about 35 to 40%, and you'd have no dividends.
Right.
If you had bought Stretch, you would be holding par, and you would have collected 7.4% in dividends. Now, if you're a long-term investor, I would say you're going to be better off buying Bitcoin, but you got to hold it for a decade,
right,
and you're not going to get cash flow. But on the other hand, everybody's got working capital. Like, I need the money to pay taxes in January or April, or I need to pay my kids' tuition, or I need to make payroll at the end of the year or pay annual bonuses. So people have that money they need in the next 12 to 24 months. That's normally sitting in a money market right now, paying 3.5% before tax and 2% after tax. If you believe in Bitcoin and crypto assets, you're like, well, I know it's volatile. I can't take the risk of being 30% short next fall,
right,
but I'd really be happy to get paid 4 times the money market, and I'm going to bet that Bitcoin won't go to 0 between now and next fall.
Right.
It's going to do this, but I don't care, because there's a company that's 4x over collateralized it with a tower of equity that's going to strip away that vol. And in return for betting on Bitcoin not going to 0 and then trusting the issuer, I'm going to get paid 4 times the cash flow of my money market, and that seems like a reasonable trade-off.
So then how much does Bitcoin have to go up at least per year in order to meet those obligations?
We have a break-even level we calculate. It's about 2.6%.
That's not much.
We have such a mountain of equity, $60 billion of equity capital, that Bitcoin only needs to go up 2.5% for us to pay those dividends forever. Now, if it goes up less than 10%, the common equity may not like the trade. Like, it may not be great for the MSTR shareholder. For the MSTR shareholder to make a lot of money on this, Bitcoin needs to go up like the S&P. We need 10% or more, and then it's a good trade for the common equity. And between 2.5 and 10, it may or may not be a good trade for the common equity. If Bitcoin goes up 0% a year forever, we have about 40 years of capital, and in 40 years we got to do something different. But that's kind of the way to think about this.
Okay, understood. And back to the history lesson, which was very useful, by the way. That is why STRC needs to trade as a public company in order to trade on those brokerage accounts, right?
Well, you could think of it as think about annuities. I give you $1 million, you pay me 7% forever. I get $70,000 a year. I bought an annuity. That's a private investment contract. It's illiquid. We've kind of just created a public investment contract, a security. It's liquid. Instead of paying $1 million to a life insurance company to buy an annuity at 7%, you buy $1 million of STRC, you get paid $115,000 a year. And the reason the instrument works really well is we have a public common equity, MSTR. We have a huge tower of Bitcoin, which is liquid, 65 billion of BTC. And then we've taken public a common or a preferred stock, STRC. And if you take the STRC public and pay a fat dividend, that's interesting. If it's tax deferred, that's double interesting. Yeah. If you strip all the volatility away so I can trade in and out every month, that's triple interesting. So to make a long story short, STRC is the biggest preferred stock in the world in 10 months. It's the most liquid by a factor of 20 preferred stock in the world in 10 months. It's interesting. And we have become the biggest issuer of preferred equity in the United States capital market last year and this year. And because we're revitalizing an asset class that was big in the 19th century. We used preferred stocks to build railroads. In the 20th century, it fell into disrepute. If you got an illiquid 6%, dividend and you got to pay tax on it, it's, it doesn't look as good as a bond. It doesn't look as good as an equity. It's, I'm bored of it. But when you get to the point where it's super liquid and that dividend doubles, okay, now I'll take a look at it. So we have created something out of existing components that have been around for 100 years, but we joined that preferred stock with digital capital, with Bitcoin, and the two of them together are a match made in heaven.
Yeah,
One surprising insight from Saylor is that institutional adoption may gradually reduce Bitcoin's volatility over time. Historically, Bitcoin experienced brutal drawdowns, sometimes falling 70% or more during bear markets. But Saylor argues that the growing presence of institutional demand is changing market structure. There are now consistent buyers entering the market daily. ETFs purchase continuously. Treasury companies accumulate continuously. Banks create Bitcoin-backed credit continuously. That steady demand acts as a stabilizing force. And, according to Saylor, that's why recent drawdowns have been less severe than previous cycles. Bitcoin is evolving from a purely speculative asset into a global financial reserve asset. And as adoption broadens, volatility may slowly compress.